Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Guoquan Food, Shanghai Co. Limited, annual report. And Guoquan Food, Shanghai Co. Limited offers a diverse range of products and services to cater to the needs of its customers. The company's product portfolio includes ready-to-eat, ready-to-heat, and ready-to-cook meals, as well as at-home prepared hot pot and barbecue ingredients. In addition to these food products, Guoquan Food also provides condiments and sauce products, beverages, fresh food, and Western food and snacks. The company's product offerings extend beyond food items to include barbecue products, solo dining meals, hot pot soup-based products, meatballs, shrimp paste, meat, vegetables, and pots and grills. Furthermore, Guoquan Food processes and sells aquatic products, providing a comprehensive range of seafood options for its customers. In terms of services, the company offers supply chain management, information technology, and enterprise management services to support its business operations. These services enable Guoquan Food to streamline its logistics, manage its inventory effectively, and maintain efficient operational systems. With a strong online presence, the company sells its products through both physical stores under the Guoquan Shihui brand and digital channels, making it easily accessible to customers across mainland China. Overall, Guoquan Food, Shanghai Co. Limited, has established itself as a prominent player in the home meal products industry in China, with a wide range of products and services that cater to diverse customer needs. Guoquan Food Shanghai Co. Limited maintains a market capitalization of 12 billion, broadly in line with the industry peer group. Guoquan Food Shanghai Co. Limited trades at a higher price-to-earnings ratio of 24 times and a higher price-to-book ratio of 3.45 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 31% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 4.41%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, sales to franchisees, online sales through mobile apps and social commerce platforms, partnerships with food delivery companies, and expansion of instant retail stores network have been key contributors. The introduction of new products, integration of online and offline channels, and deepening brand image through high-quality content have also driven revenue growth. Furthermore, the company's investment in AI, big data, and IoT technology has enabled smart retail scenarios, while increased R&D investment and enhancement of innovative capabilities have led to optimization and upgrade of existing products. The creation of new product portfolios with a high quality price ratio and expansion into overseas markets through phased exploration have also contributed to revenue growth. On the decline side, store closures at a rate of less than 4% indicate potential decline in revenue due to store closures. Impairment of non-financial assets and goodwill has also led to revenue decline. Estimation uncertainty related to impairment testing has further exacerbated this issue. Overall, the company's revenue growth is driven by a combination of factors, including sales expansion, product innovation, and strategic partnerships. However, potential risks such as store closures and asset impairments must be carefully managed to maintain revenue stability. Net income experienced a significant surge of 88.2% from RMB 100 and 41.2 million in 2024 to RMB 400 and 53.9 million in 2025. This substantial increase is also reflected in the plus 88.6% growth rate mentioned elsewhere. The improvement in net income can be attributed to various factors, including adjustments for non-recurring items such as gains or losses on fair value changes and donations. Profit margins also underwent a notable transformation, rising from 3.7% in 2024 to 5.8% in 2025. This represents an increase of plus 55.1%. Furthermore, the company's core operating margin non-IFRS saw a significant improvement, growing from 4.8% in 2024 to 5.9% in 2025. The overall enhancement in profit margins can be attributed to the adjustments for non-recurring items mentioned earlier. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the extracted summaries, the company has consistently produced positive operating cash flows in both 2024 and 2025. Specifically, the amounts of RMB 588,420 and RMB 530,908 were reported for 2025 and 2024 respectively. Furthermore, net operating cash flow was also recorded as a positive amount of RMB 1,283,369. These figures collectively demonstrate that the company is generating sufficient cash from its core operations to support its business activities. The company's debt level has undergone significant changes over the past year. According to the financial statements, interest-bearing bank and other borrowings have increased by a substantial 105.9%, rising from RMB 67.5 million to RMB 139 million. This increase is also reflected in the total debt, which has risen from RMB 67,510,000 to RMB 139,043,000. Furthermore, non-current liabilities have seen a notable 50% increase, jumping from RMB 82,296 to RMB 123,284. The company's interest expenses have also experienced significant growth. Interest on bank and other borrowings has increased by 14.4%, while the accretion of interest recognized has surged by an impressive 107.6%. This substantial rise in interest expenses is largely due to the increase in debt levels, particularly the significant jump in bank and other borrowings. The gearing ratio, which measures a company's level of indebtedness, has also seen a notable change. The gearing ratio has increased from 3.2% to 6.7%, indicating that the company's reliance on debt has grown significantly over the past year. This increase is consistent across multiple financial statements, highlighting the substantial shift in the company's financial position. The recent market analysis reveals a mixed performance across various regions. On the positive side, overseas markets have shown impressive growth, indicating a strong demand for local products globally. Similarly, Hong Kong's special administrative region, China, has also performed well, suggesting a thriving economy in this region. However, there is limited information available on mainland China's performance, making it difficult to assess its current market situation. In contrast, overseas markets and Hong Kong have demonstrated significant growth, highlighting their potential for future investment and expansion. And management is emphasizing a holistic approach to managing the company's businesses, with senior executive management overseeing resource allocation and performance assessment. This indicates a focus on integrated decision-making and strategic planning across various departments. In addition to this, management has reaffirmed its commitment to sustainable corporate development. Key areas of focus include product quality and safety, consumer service, compliance, employment practices, environmental protection, and public responsibility. These priorities suggest that the company is prioritizing long-term sustainability over short-term gains. The equity investments have been characterized as strategic in nature, implying that they are intended to support specific business objectives or growth initiatives. However, there is no clear statement on the company's long-term outlook or strategy, leaving some uncertainty about its future direction. The company has demonstrated a commitment to returning value to its shareholders through various means. In terms of dividend payments, the company has issued both final and interim dividends for the year. The total dividend payout for the year was RMB 190.3 million, with each share receiving a final cash dividend of RMB 0.0381 and an interim dividend of RMB 0.0716. In addition to dividend payments, the company has also engaged in share buybacks. During the period, the company repurchased shares worth RMB 183.9 million. This indicates that the company is actively managing its capital structure and seeking to optimize shareholder value through strategic investments and returns. Concerns about inventory buildup and supply chain disruption. There are several indications of potential concerns regarding inventory buildup and supply chain disruption. On page 33, it is noted that inventories have increased by 16.1% from RMB 691.8 million to RMB 803.2 million. This significant increase in inventory levels raises questions about the management of stock and whether there may be issues with supply chain efficiency. Further analysis on pages 182, 203, and 217 reveals additional concerns. The cost of inventories sold and impairment losses on inventories suggest that there may be problems with inventory buildup or supply chain disruption. Similarly, the increase in raw materials and finished goods inventory levels, coupled with a decrease in provision for impairment of inventories, indicates potential issues. The significant increase in amounts due from related parties on page 217 also raises concerns about inventory buildup or supply chain disruption. Additionally, changes in trade receivables and payables suggest that there may be problems with cash flow management and inventory control. Overall, these findings indicate a need for closer examination of the company's inventory management practices to prevent potential disruptions to its supply chain. That concludes the financial summary for Guoquan Food, Shanghai Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.